Where do we draw the line with the music? Where do we stop and start the intro?
I've got to gradually fade it out. Let's go. Fade out.
Start the fade out. Hello and welcome. You are joining us live on the Investor Lab, the home for passionate people seeking a life of freedom, choice, and abundance. And we've got a ripper of an episode today. Gabby, how are you?
I'm fabulous. Sorry, who are you?
My name is Goose. If you don't know who I am, my name is Goose. And your name is Gabby. Welcome.
My name's Gabby. Okay. Oh,
hey, Roman.
Music's still going. Music
hey,
is still going.
81. Yeah, we'll just leave the soundtrack, you know.
That's like, just great.
I've always kind of liked the idea of cruising around in life and just having a soundtrack playing the whole time, so maybe we can do a little bit of that.
This does kind of feel like our soundtrack. I mean, it has been 4 or 5 years, however long it's been.
Indeed.
Let's keep it going the whole episode. Okay.
Indeed. Well, we've got a ripper episode today. We've got a lot, an action-packed episode full of very interesting stuff that we want to cover. Let's start with the big headline. The RBA has slashed interest rates.
Slashed.
Oh, my God.
Sound like Franco Cozzo or something. Slashed prices.
Yeah, exactly. It's quite funny, right? So the RBA has cut interest rates by a whopping 25 basis points. That is 0.25%. But the reason that is so interesting, though, and the reason that people are like losing their proverbial lunch over
nice.
Yeah, nice save. The reason that people are losing their lunch over it is because it is the first time we have had an interest rate cut since, correct me if I'm wrong, November 2020. And
yes,
that's a long time ago. That's a long time for a lot of people. A lot of people haven't even been investing that long. A lot of people just, that is a really long time for a lot of people. November 2020, if you really think about what was happening in November 2020? November 2020, we were still in a period of negative GDP growth, which I'm going to talk a lot about some of this macro stuff as it relates to this. We were in a period of negative GDP growth coming out the back of COVID. So, that was, it was a pretty wacky time. And so since then, either interest rates stayed flat or raised. So for a lot of people, this is going to be the first interest rate cut they've experienced as an investor. Or if they're just getting into the market, they might just be starting the investment journey. This might be the first time they've been at the start of a rate cutting cycle. And so for a lot of people, I think it's creating a lot of optimism. It's creating a lot of excitement. It's creating a lot of momentum. And I promise I'll shut up and let you get a word in edgeways in a second, Gabby, but just let me waller around in this for a second. It's super interesting because, a 25 basis point interest rate cut only increases borrowing capacity by what is it about between 2 and 5% roughly, right, Gabby?
Yep. Yeah, about that.
So the actual impact of this is somewhat insignificant. Not absolutely insignificant. It does make a bit of a difference, but but in terms of what it does for people's psychology, that's actually where it makes the biggest change. And I think there's a lot more to unpack here. There's a lot of people, you hear a lot of people talking about interest rate cuts. Oh yeah, you'll save $50 a week on your mortgage. Look at this. It's a big news story. I actually think there's so much more to this news story. I actually think that there's so much more that we need to unpack. Everything from the economy to bond maturity rates to, GDP growth, so much more. I think this is a really interesting time. But anyway, Gabby, what do you think about this topic?
I mean, this is why I really wanted to do this, because obviously, the rate cut happened the announcement happened on Tuesday. And so everyone in this kind of space is going a bit nuts because, like you said, it's the first one in over 4 years. And obviously, surface level, it's a good thing. Looking at, as you said, the reduction in repayments in loans, those that have large amounts of debts, it's going to benefit your cash flow. If the banks pass it through to you, it'll benefit your cash flow in the daily cash flow in terms of your costs will come down a little. But there's obviously, if you've been listening to this show, if you've been hearing Goose and I talk for the last couple of months, there's more to these decisions than can come through in the news and come through in the headlines. So why I wanted to do this is to kind of go a bit deeper with the topic and talk about what this might indicate, and so that people can actually start to think more strategically and more what's the word I want? Analytically?
Critically?
critically, that's what I want. Thank you. More critically about these announcements and not just relying on the headlines, because the headlines and the people that you speak to, it's probably going to be like very good news. Rates are going to start coming down, yada yada yada. And I don't want our community to get caught in the hype and caught in what everyone else is saying. I want you to understand what's happening and being able to think more critically about it.
So to be clear, I think it's a good thing, but I think I think that everything needs to be understood in the context. And this is a situation where good news can be bad news and bad news can be good news. And so it's a couple of little anecdotes I want to add into this. So I had a client contact me the other day. They've only just got their pre-approval, so they've only actually just started searching for a property with us, and they called me very anxious. This was on Monday, the day before the interest rate cut. And they were like, oh my God, we're going to have to find a property ASAP. We'd only been looking for a property, for like a week or something, right? So, but they were like, we've got to find a property ASAP. The RBA is going to cut interest rates tomorrow. The property market's going to explode. I'm going to miss out. We've got to go, 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 go. And I was like, chill. Chill.
Yeah.
Chill.
Yeah.
Yes, there are structural tailwinds for the property market. Yes, we've been saying that for months. We've been saying that for, you could go back and see episodes the middle of last year saying that 2025 is going to be a very big year for the real estate market. But it's not just because interest rates have gone down. So we actually did a, I have another anecdote that I want to add in here as well in a second, but we actually did a study on the relationship between interest rates and property prices a couple of years ago. We discovered that there was a fairly nominal or relatively insignificant correlation between interest rates and property prices. Now, specifically, what that looked at or what we discovered was as interest rates go up, that does not mean that property prices go down. But interestingly, as interest rates go down, there is a higher propensity for property prices to go up. Now, the question is why? Is it because interest rates go down? Or is it because that is a correlation with a different factor? Like, is that causation or correlation? Right. And in fact, it's correlation, not causation. And I had actually a friend reach out to me yesterday and he asked, hey, Goose, what are your thoughts on the 18.6 year property market cycle? Are we heading into the mania phase? And if anyone's familiar with Phil Anderson's work on the 18.6 year property cycle, broadly what that points to is a mania. I won't go into the whole kind of thesis around it. In fact, I did do an episode with I can't remember his name right now, but I did do an episode with one of the guys that kind of is part of that organization a couple of years ago. It's a really interesting theory. And what it points to is that 2026 is going to be a mania phase and everything's going to boom. And then there's going to be some mega crash. The reason I bring that up is because I don't think that's true, right? And so people kind of like looking at this and getting hyped up and interest rates are cutting. What's going on here? What's driving all of this? Fundamentally, everything is still being driven by cycles of liquidity. And so what we need to look at is not just have interest rates being cut. Are we about to have a boom? You need to actually sort of think about, well, what are the driving factors that would cause things like property price growth or asset growth generally is actually probably a better way to think about it. Because what we'll probably see is we'll probably see higher levels of business prosperity. We'll see higher valuations. What we'll see in capital markets is we'll see hurdle rates go down on funding. And so what we'll probably start to see in the media is higher valuations for companies and lots more companies raising capital and all of these things. Capital market composition has got to change significantly as well. And all of this is driven by something bigger than just interest rates. The RBA broadly has a mandate to keep employment high, inflation under control, and stable prices, right? Basically. And so what does stable prices mean? Stable prices mean, that we don't have, highly volatile prices. It means that the Australian dollar stays relatively stably pegged to, the US dollar as an international reserve currency, all of that kind of stuff. That's broadly the message or the mandate of the RBA. It's very sort of rubbery. What is high unemployment? What is stable? What are stable prices? And what does it mean to keep inflation under control? Now they've had a target band of inflation of between 2% and 3%. But even that is just a guideline. It's not a rule. So I think that this is an opportunity for us to say, okay, well, what is changing about the RBA's point of view on the Australian economy? And then how might we leverage the second order aspects of this information to form a better view of how we might think about investing in 2025 and also into 2026? What do you think?
Awesome. Yep.
Great. Do you have any kind of additional thoughts or any comments on that before I kind of keep on the waff?
Keep on the waff. No, I think I'm just thinking through, like, I would love if you're here live, if you want to answer, like, what was the first thing that you thought when you heard about the rate cuts?
Mm.
What came to mind? Were you excited? Did you have that bit of panic, like Goose mentioned about our other clients? What has come to mind for you if you're here live, or if you're listening later? Hello. Think about that to yourself. Like, how did you react? How did you respond when you heard that news? Was it positive? I think because that's going to help you to realize your perspectives as we approach the rest of this conversation. Just thinking about where am I starting from? What did my body like think is going to happen? Did I feel threat or did I feel excitement?
Yeah, totally. Me personally, I mean, I'm for it. I'm all for it. I'm like, yeah, increase liquidity. Let's go. I like things to move. I like to have money flowing around. I like liquidity to be in the market because that's what creates opportunities. But it's actually quite interesting because if you think about it, well, why would they cut interest rates? So one reason they would cut interest rates is because potentially inflation is moving down towards their band. Okay, so what we've seen is the preferred measurement of CPI of inflation for the RBA is trimmed mean CPI. Now, there's a bunch of different definitions about CPI, and frankly, the CPI basket is a bunch of horseshit, basically, because it's so manipulated and they change it all the time and they add stuff in and they take stuff out. It's not a very good metric or measurement. Nonetheless, let's just use what they use. So Australian trimmed mean CPI on the latest reading in Q4 2024 was 3.2%. Now, that is slightly above the range of 2 to 3%, but that has come down from 6.8% in Q4 2022. So that's a 52% decrease in the CPI in 24 months. Now, everyone thinks, right, when inflation goes down, prices go down. No. It just means that prices go up less fast, you know? So it's still, we're still getting inflation at 3.2%, which is still pretty high. Now, but what that shows is a very strong trend, like a very strong trend. There's been a consistent decline in the inflation rate over the last, 24 months, right? So it hasn't been volatile. It hasn't been very spiky. I'm just wondering if I can potentially bring up a graph here to kind of show you trim mean CPI year on year. It hasn't been very spiky. It's been a very solid decline. Let me just bring up a graph here to kind of show what this looks like. If you just give me 2 secs.
Yeah, awesome. While you're doing that, Roman's actually just said his response to the rate announcement. It's a slight fear that the impending growth may not align with my timing, as I won't be in for property number 2 until later this year. Yeah. Totally fair response, Roman.
Yeah, that's cool. Let's talk about that. That. So let me just quickly share my my screen here. So I should be sharing now.
Yep.
Yeah. So we can see here Q4 2022 actually was 7.8. Have I got the wrong one? Oh yeah, sorry. RBA trimmed mean.
Doing it live.
CPI. Yeah, quarter by quarter. There we go.
It's funny as well how much time you spend in these charts.
Yeah. Oh no.
It's basically a bookmark.
Yeah. Okay, so we can see here it's been a pretty steady decline. Okay, I'm not pulling up the correct chart, but you can see here it's been a pretty steady decline down without much volatility, right? So this is really strongly trending in the right direction. And so what that points to is that there's pressure that is pushing inflation down. So we can start to feel comfortable that is moving in the right direction. Now, that is probably one of the reasons that the RBA was like, okay, we can feel comfortable starting to lower interest rates. But let me just kind of reposition that. That's what they need in order for them to feel comfortable in doing it. But it's not the reason to do it, right? It is to kind of flip that around. If inflation was higher or not trending down, that would be a reason to not lower interest rates. But there are other reasons to lower interest rates. So they're not lowering interest rates because inflation has come down. That is not true, because they could afford for inflation to come down further. They could afford to allow it to mean revert down to 2% or even 1%, because we've been pretty high. Then they could kind of they could kind of get it further and further under control. But the issue is not what is the inflation rate. The issue is things like what's happening in the unemployment rate, what's happening in the GDP, the economy. These are the most important things that they're actually kind of looking at. And if we take a look at some of those numbers, the unemployment rate has increased from 3.4% to 4.1%. That's from October to January. I think there might have just been new employment numbers that came out today. I don't have those to hand, so I'm working off the January, not the February numbers. So these might slightly be wrong. But nonetheless, unemployment's increasing from 3.4% in October 2022 to 4.1% in January 2025. That's a 20% increase in the unemployment rate in 27 months. So we had a 52% decrease in the trimmed mean CPI in 24 months, a 20% increase in the unemployment rate in 27 months. And then just one other piece that I want to put in here as well is GDP. So we've got unemployment is trending upwards pretty consistently on a very nice and consistent uptrend. Not that it's nice that unemployment's going up, but that's like, it's a nice looking trend. If you like to ogle trends like I do, that looks nice. Then this is what's really interesting to me. The quarterly GDP growth rate in Q3 2024 was just 0.8%. That's down from 4.8% in Q3 2021. That's an 83% decline in quarterly GDP growth rate in 3 years. It's currently the lowest quarterly GDP growth rate since Q4 2020. What else happened in Q4 2020? The last interest rate cut, by the way, was in Q4 2020. Q4 2020, which was during COVID, that was a negative 0.3% GDP growth rate, quarterly GDP growth rate. So it's the lowest it's been since then. And I would also point out that the last reported quarterly GDP growth rate in Q3 2024 was 0.8%. That is lower than Q4 2000, which was the dot-com bust, which is 1.2%, and Q1 2009, which is the GFC, which is 1.6%. So to put that in context, 0.8% in the last measured quarter of GDP growth versus 1.6% during the GFC. That's half as good as when the GFC happened. So that points to a significant underlying concern from the RBA about the overall growth and stability and health of the economy. And I'm just going to
go for it. You're good.
Tell me to shut up if you need to kind of get a word in edgeways, because I think this is really interesting. Because what's actually happened is we've actually been in a recession, although they haven't officially announced it, because what it has been is a per capita recession. So we've had negative GDP growth per capita in Australia. So what's been happening is GDP growth rate has been going down and population has been going up. And what that has created is a negative GDP growth per capita. So we've been in a per capita GDP recession for the last 6 quarters. So that is not good. That is not good, right? So, and this is what one of the things I said earlier was good news. Good news can be bad news, and bad news can be good news. So you can hear like, oh, interest rates are coming down. Yeah, property party. But it's like, well, why? Well, actually, the reason that is the case is because the economy is sick. We've been pumping up the economy. We've been artificially inflating the economy by shipping in record amounts of migrants, which are bringing money into the country, all of this kind of stuff, which are changing the dynamics of how we measure GDP on a per capita basis, all that kind of stuff. And that has been skewing the data, but that's not sustainable. So you sort of in this situation where unemployment is going up, GDP is going down. We're in a per capita recession because we've had 6 quarters of negative GDP growth per capita, which is not good. And that is why they're going, we need to stimulate the economy. And it's just that inflation has come down enough that they feel like, okay, we can start to stimulate the economy without hopefully blowing up inflation. So it's not because inflation has come down. It's just that inflation has come down to a level which can allow them to start to stimulate the economy in a way that's going to stimulate more growth.
But even on inflation, right, they change the measurement of that, don't they? The CPI. So if they're using that as their kind of headline campaign of why they're a reason to move this forward, like progressing with an easing cycle, But even that, how they technically measure that changes, right?
Well, yeah. So they add and remove things from the basket of goods that make up CPI. So
Mm.
yeah, it hasn't been a stable, consistent measurement. I think look, I don't know about Australia, but I was looking at something from the US, and it was like if you used, I can't remember what the inflation rate is in the US, but let's say it's like 2.4% or 3% or whatever it is, right? But it was something like if you used the same CPI basket as they used in like 1980, the inflation rate would be 9.8% or something like that. But they've just
Mm.
taken all the stuff out. It's like, oh, people, no, people don't drink coffee anymore. People don't drink coffee anymore. So we'll take coffee beans out of the basket.
Everyone drinks oat milk, so we'll take dairy milk out.
Yeah, exactly. It's like, people don't, people don't go to the movies anymore, so we can take entertainment costs out and stuff like that. So
Right.
they definitely manipulate those numbers for sure. So it's definitely not a perfect measurement. No.
Yeah, interesting. So would you say then a fair, like, signs of a weak economy would be unemployment trending up?
Yeah.
Oh, yep. Robot agrees. Uh, GDP growth trending down or stagnant, like not
Yeah.
growing.
Yeah.
Inflation not,
Well,
if it's too high, but then also too low. Like they're kind of aiming for this 2 to 3%.
yeah.
Right?
So if you have high inflation and low, and you have low growth, then you have stagflation, and that's bad, right? So
Mm.
if you have inflation trending down and GDP trending down, and that's kind of like they're kind of like doing this sort of same things, right? It's very hard to, like, if you have a growing economy, you tend to have a little bit of inflation, and that's why they tend to try and slow down the economy, using interest rates. Now, one of the mechanisms of interest rates, and one of the reasons it's less effective, is because of total debt to GDP ratios. So once upon a time, the easiest mechanism that a country could use to kind of speed up or slow down the economy was interest rates. Now, that worked when total debt to GDP was less than 100%. So if it was 20%, 30%, 40%, 50% or whatever, it worked really, really well. Because what you could do is you could say, hey, whoa. We're growing a bit too quick here. Everything's getting a little bit out of control. We need to slow it down. So what we'll do is we'll increase the cost of borrowing. That's going to stop businesses borrowing capital. It's going to stop people borrowing capital because the cost of borrowing is going to be too high. That's going to slow things down, and that's going to, temper growth a little bit. We'll get things back under control. We'll progress in a nice, orderly fashion. And that's important because if you grow too quickly, you tend to mean revert. So you have like booms, you increase booms and bust cycles. So the whole idea of using interest rates as a monetary policy tool to manage growth was to try and reduce the boom bust kind of cycles.
Mm.
Now, the problem with that is when total debt to GDP goes above 100%, then what you actually end up with is a situation where the interest rates become stimulatory, not contract, like not tight, whatever. What the opposite of stimulatory is? I can't even think of the word. But it becomes stimulatory. The reason for that is because one person's liability is another person's asset. So that interest gets paid somewhere. So that turns into liquidity, and that flows around in the economy. And so that turns into money that's sloshing around. Now, Australia and the US are very different in the composition of their debt structures. So Australian government debt to GDP, I don't have it on me, but I think it's like 40 or 50% or something. It's not, or maybe 60%. It's not crazy, right? It's like it's
Total debt, yeah. Total debt.
No, government debt to GDP.
Government debt. Yep.
Yeah. So government debt to GDP is not crazy. In the US, it's like 127, 130%. It's crazy. In fact, there's only been a couple of times in history when a country has hit 130% debt to GDP and hasn't completely collapsed, right? So like 95% of the time or something, when countries reach 130% debt to GDP, government debt to GDP, they basically collapse. So it's not a pretty picture in the US. Australian government debt to GDP is much lower. I can't remember the number, and I could look it up now, but I'll multitask, and that wouldn't be good for anyone. But it's it's like, yeah, it's like 40 or 50% or something. It's not crazy. But Australia's total debt to GDP is about 250%, which is pretty high. So we have a much higher rate of private sector debt than the US. What that means is we have more household debt and we have more business debt. Now, that's not a bad thing or a good thing. That just is, right? And it's just a constitution of makeup. In the US, there's less household debt, way more government debt, and I would argue that that's way worse, right? Because like as a percentage of GDP, if the government is like that deeply in debt, that's not a good thing. Now, so what happens, like, given that Australia's got a roughly a 250% debt to GDP ratio, is when interest rates go up, that can actually still be stimulatory, which is also why we find it doesn't have a negative impact on the property market broadly. What it'll have is an impact on some pockets of the property market. So, for example, typically higher price. So there's different tranches of the market, right? So when I say higher priced markets, I don't mean the $10 million median house price markets, because those people typically don't use loans. But your kind of like $800,000 to $2 million homes, right? Those kind of suburbs, those markets tend to get significantly adversely affected by increases in interest rates, because it affects affordability when people are stretched right at their edge, and it pushes people down into kind of more affordable pockets. So even when interest rates go up, it can actually be stimulatory, but it doesn't mean it stimulates everything. So what it means is it can push more liquidity into different pockets, and that's why you see more growth in a broader kind of subset. Now, the opposite is also true, by the way. So as interest rates come down, those higher priced markets that I guess what you would say is like on the high end of what people can afford as employees, basically is probably how you would think about it. Those kind of markets where it's like $800K to $2 million properties, something like that, they tend to get not adversely affected. They tend to get receive a higher impact from interest rate moves either way. So as interest rates come down, more people are able to squeeze into those markets, which increases the demand in those markets, which pushes those prices up a little bit. So you do see some variance in some specific markets, but broadly, you don't see that really taking shape. And so what you still see though is this liquidity functions both ways, and this is why interest rates are no longer an effective mechanism for economic control, because debt to GDP is about 250%. So if you raise interest rates, that increases liquidity into the economy and pushes more money, just pushes it out in different ways. You lower interest rates, and what does that do? That increases people's ability to keep money in their pockets, which is another way of increasing liquidity, because liquidity is being forced in and around the economy in a different way. It's just not going through the function of a loan to somebody else. It's staying in people's pockets. So the same amount of money is floating around. So the question you've actually got to ask yourself is, what is the liquidity? Because if all interest rates do is act as a function of diverting liquidity to different places, either it diverts it into my pocket as an individual, or it diverts it into the pocket of a bank as a loan holder, all interest rates tend to do now is act as a directional guide of where the liquidity is flowing to. So the actual better metric to look at is what is happening with liquidity broadly. Now, M3 money supply in Australia has increased by 5.4% in the last 12 months. Now, that is less than the kind of average 10% over the last 60 years, but it is still a lot. But that is still quite a lot of money to be pumping into the economy. And one of the other things that's been impacting the liquidity pretty significantly, particularly over the last couple of years, has been the increasing trend towards fiscal dominance in Australia. Now, up until fairly recently, so there's effectively two economic regimes. One is monetary policy dominance, and one is fiscal policy dominance. So monetary policy dominance is when an economy is broadly driven and managed by the actions of a central bank. So either the printing of money or the tightening of money. So that's quantitative easing or quantitative tightening, or interest rate control and bond yields and all of this kind of stuff. So that is when the person at the steering wheel, or the organization at the steering wheel of the economy, is the central bank. Now, if what happens is government's activities become more dominant in driving the economic movement, then it starts to move into a place of fiscal dominance. Now, what does that look like? So fiscal dominance is when government spending, government decisions like tax cuts, all of that kind of stuff start to move the economy more than central bank policies. Now, interestingly, the US is definitely, absolutely in a state of fiscal dominance, to the degree that the Fed has almost lost any kind of control of the economy. And now it's really up to, like, how can the government control spending? How can the government increase productivity and all of that kind of stuff? Australia is still in a monetary dominant framework, but it's been trending much more towards a fiscal dominant framework. So it's still, the balance of power, so to speak, still sits with the RBA and the central bank, but we're starting to trend much more towards a fiscal dominant framework. And we could see that recently because Michelle Bullock wanted to lower interest rates, but wasn't able to because governments, state governments and federal governments were spending too much and running such big deficits. And that was pumping more liquidity into the economy, which was keeping inflation high because of the stimulatory nature of liquidity. So liquidity still continues to be the main driver that underpins all of this. And everything else is just a factor of how do we think about the control of liquidity.
So the power to some degree is shifting away from the RBA and more towards states and federal, like the government decision about how to spend money, right?
Well, yes. Yeah, I would say the trend has been in the direction of fiscal dominance.
Mhm.
We're not there yet, and it doesn't mean that the trend is going to continue to go that way. So I don't know. So it's
Yeah.
hard to say, like, you know,
Hard to
where
say.
are we going to be? Where are we going to be in a year's time or 2 years' time? I don't know. But what
Yeah.
I do know is fiscal decisions have had significant impacts on the economy. You know, immigration decisions,
Yeah.
taxation decisions,
Yeah.
government deficits. These kind of things have had a really big impact on the economy and have taken the controls away from the RBA. Now, you can absolutely argue, like, is it even appropriate for the RBA to have the controls of the economy? You can absolutely argue that. But the point here is that as that changes, you've got to also think about, well, who then is in control and how are they managing all of that kind of stuff? Because what tends to happen is when you end up with a government, and this is why there's typically a separation of authority between the central banks and the governments, right? That's why if you look at the US, Donald Trump can't sack Jerome Powell. Like there's a separation.
He'll try.
Yeah, there's a separation between those two entities because what you tend to see, and you see this a lot in emerging markets, is when you see governments being able to control the monetary policy or through fiscal dominance control the economic growth, you tend to see economic collapse, right? It moves pretty quickly. And why is that, right? So then the question is, like, why is that? The reason that is the case is because all politicians are in the business of being reelected.
Mm-hmm.
And so now you can push that to the edges and you can go look at some of the countries where there's a lot of corruption in Africa. And you can go, okay, a military coup will take place. Some power hungry, general or whatever will take over the government. And then the government will make all of the decisions that drive the economy. And then it creates a huge amount of chaos, huge amount of poverty, huge amount of economic collapse. Him and his cronies get rich and the whole place goes to shit, basically. So you can see that on the edges, but then it's just a gradient of that.
Mm-hmm.
And so we need to be really careful about how these things play out and be very aware of what that means for us as individuals. Now, it doesn't mean that there's any reason to panic, but really this is just a point of understanding the environment you're in so that you can make more informed, more intelligent investment decisions. Now, if you just give me a couple of seconds, I want to swing back because the friend that asked yesterday around the 18.6-year cycle, he said, hey, do you think what are your thoughts on the 18.6-year cycle? Do you think we're in the mania phase of the 18.6-year cycle? And I said, well, no. It's good because we did an independent study on the 18.6-year cycle, and we couldn't find a correlation between. Now, I've read the book. It's not that, and if you want to read the book, it's called The Secret Life of Real Estate and Banking. It's awesome. It's very chunky. It's very hard to read. It's very big. It's pretty, but it's very cool. It's very awesome. And I don't want to say Phil Anderson's wrong. I actually think that Phil Anderson was probably right. You read through the book and you go, okay, there's a lot of stuff in there that makes a lot of sense. The challenge that you've got, though, is that, there's a saying, there's lies, damn lies, and statistics, right? So you've got to be really careful. Like, data can tell you all kinds of things. And what I would say is that I think that the framework of the 18.6-year cycle has been very useful and has had some evidence of playing out at times. But what's actually more interesting and more true from my point of view is that in 2008, we effectively had a reset of the global debt refinancing cycle. And then we had another reset in 2020. And so what do I mean by that? So during the GFC, basically interest rates went to zero and pretty much every government in the world basically refinanced all of their debt to 0% interest rates, right? And the way that they have debt is it's managed through a mechanism of treasury bonds, right? So then what you've got to look at is like, what is the treasury bond maturity rate, and how, like, what is the average treasury bond maturity duration? And we also had another reset effectively in 2020 when again interest rates basically went to zero. So we had this reset, and then we had another reset. And so we've had these opportunities for interest rate cycles to sync up. And that's why we've been able to start to move into, particularly since 2008, global liquidity or liquidity functions have become the main thing to pay attention to. Now, I would say that it was different if you go back further. And I would say that Phil Anderson's work probably made more sense before that. But I'd say over the last 15 years, I think the function has specifically changed. Now, what is interesting about that is to think, okay, well, if that's true, and liquidity is actually more important to understand than the rest of it, and if we can understand how liquidity fits in with this framework, and if we can understand that effectively the Australian government debt was reset to 0% in 2020, well, and if government loans or their debt is basically held in a function of treasury bonds, well, what is the average treasury bond maturity duration in Australia? The answer to that is 6.7 years. That's the average. And so
Mhm.
if interest rates, if basically, you think about it like this, if the government, refinanced all of their debt, for lack of a better term, in 2020 at 0% interest rate, and the average bond maturity is 6.7 years, what does that mean for us now? Well, we're at the start of 2025. So you can reasonably assume it's not a hard fixed, okay, it's all at 6.7 years. There's a bell curve, right? So somewhere between 5 years and 8 years is going to be kind of like the kind of bell curve duration of that they need to refinance these treasury bonds. We're in 2025 now, so that's 5 years after 2020. Okay, does the government want to refinance its debts at a high interest rate or a low interest rate? Of course, it's going to want to refinance its debts at a low interest rate. And so there's a real incentive to lower the interest rates so that it can get through this debt maturity wall and refinance its debts at a lower rate. So we're at the start of 2025 now. And if the average duration is 6.7 years, that means, in my point of view, that what we're going to see is a trend lower in interest rates through 2025, 2026. And even potentially into 2027, such that the government is able to refinance its debts at a lower rate. Now, this is an important distinction. The US is actually on average 5.9 years, but that's the average, not the median. I think if you took the median, what you would actually find is that it's more like 4 years, because what's been happening is they've been issuing shorter and shorter duration bonds because nobody wants to hold long-term US debt. So their cycle is much more on a kind of like a 4 to 5 year refinancing cycle, which also makes sense because
Mm.
the US started cutting interest rates late last year.
Yeah.
So we're now operating on these two slightly different cycles. So, and this is a really important thing that I want people to try and understand, which is why I'm banging on about it so much. Because effectively what happened is all the governments synced up their kind of like debt refinancing cycles in 2008. So everyone was operating on the same kind of like cyclical debt refinancing type thing. And you could kind of track it, and there's a lot of research around that's really awesome. Now, every other part of the world, the ECB, the BOE, the PBOC, the BOJ, what other acronyms could have come up with, but they're all the central banks basically started their easing cycles last year because their debt maturity walls are at a different debt maturity rate than the Australian debt maturity rate. Now, sorry to keep waffling on. Why
Yeah.
why are their debt maturity wall rates, debt maturity durations shorter? It's because people don't trust those economies as much. Australia has a really strong reputation as being a very robust economy. We've avoided recessions, we've navigated heaps of stuff. And so people have confidence holding longer duration Australian debt than they have more confidence holding longer duration Australian debt than they do holding longer duration UK debt, European debt, US debt, any of this kind of stuff. So because all of these other economies are less creditworthy in the eyes of bond buyers versus Australia. Australia's got a great reputation economically. And so I would argue that's why we have a longer debt maturity duration. But what that also means, and I started to talk about this last year, is that I think that Australia is starting to dislocate from this kind of global refinancing cycle, and it's becoming what we would call right adjusted. So when we think about what I mean by right adjusted, it means that we're slightly, if you kind of looking on a timeline on a graph, we're going to be slightly to the right of everyone else, slightly kind of playing like our refinancing cycle is going to be a little bit into the future. So I think that this can be a really, really good thing, because what this kind of points to is, and sorry, so I have so much to talk about here, so I apologize if I keep waffling. Take one step back. What I've noticed is even the US cycle seems to be becoming right adjusted versus where it should be. So even if you look at the US cycle, and that is specifically because of how Donald Trump is approaching things like tariffs and policies and stuff like that to try and, he has to weaken the dollar. There's a whole bunch of other stuff there we can get into. But because of policy decisions that are being made at the fiscal level, or the government level in the US, because remember, the US is fiscally dominant, not monetary dominant, that is starting to shift that liquidity cycle to the right. And so what I expect to see in the US, is peak liquidity, or even like, global liquidity, peak liquidity somewhere around late 2025, even early 2026, maybe even into the first quarter of 2026. So that's kind of where I'd start to think that that's going to start to peak from a global liquidity basis. But I think that Australia has become right adjusted to that. So what that would kind of point to is that the Australian liquidity cycle is probably going to be pushed late 2026, which kind of lines up again with the sort of 6.7 year treasury duration. So I think this is really, really interesting as we start to then think about, okay, so what does this mean as we move forward? I know that was a lot to kind of dump out there, but did that all make sense?
It did. No, I'm just thinking through the like the impact on our everyday finances, like how, if liquidity is going to keep trending up and then rates are likely to keep trending down over the next year-ish, year and a half, that surely impacts people on a daily level, right? That impacts liquidity, impacts our purchasing power. Yes, rates might come down on a top level, headline level, but in terms of the impact of more liquidity in circulation, it makes it harder. Like people's dollars go not as far, correct?
Can you restate the question? So if interest rates, what do you mean by they don't go as far?
As in people's purchasing power is going to continue to get weaker.
If liquidity increases?
Yes.
Not necessarily, no. So liquidity is a function of the movement of money, not necessarily just the increase of money. Right. So what we can actually find is we can start to see liquidity move to other parts of the economy. So what I was saying earlier around like if interest rates go up, that doesn't change the total amount of money flowing around the system. It just changes the direction of where that's going. So where's that going to flow to? That's going to flow to banks. That's going to show up in bank profits. That's going to mean that bank share prices go up. Shareholders, they benefit, etc. Lower interest rates mean that some of that gets diverted. Some of that liquidity gets diverted to the pockets of everyday Australians. And so rather than that liquidity that is already in the economy moving around, going to the banks or to some kind of other entity or dividends to shareholders or whatever, that can actually show up in your back pocket. And so liquidity increase doesn't necessarily, the liquidity movements don't necessarily equal monetary debasement. If we continue to see the function that increases monetary debasement is how much is the money supply increasing. So the money supply has increased by 5.4% in the last 12 months. That's M3. We could check M0 and M1 as well. So we are still debasing the currency. Now, we, though, are still in a stage of quantitative tightening. So as quantitative tightening starts to finish up, and what will more likely happen is we'll move to a stage of quantitative easing. What that will mean is we'll see an increase in things like the money supply. Now, the increase in the money supply will translate to increased liquidity, right? Because the liquidity is actually the movement of the money. It's like all this money like sloshing around in the economy. More money, more liquidity, sure, right? But even if you capped the amount of money, you could still increase liquidity by increasing the velocity of money and the transfer of money in the economy. So you could have like a lot of liquidity moving around, but have a fixed amount of it. Or you can increase the amount of it and therefore increase the amount that's sloshing around as well, right? So there's sort of two dynamics to that. Now, what I reasonably expect to happen, and because I've been looking at like heat maps of easing cycles and all of that kind of stuff, Australia is moving into an easing cycle. It appears that way. So unless something significantly changes, it is currently my view that it is more likely that we're going to be moving into an easing cycle. Now, easing doesn't just mean interest rates go down. Easing means we could be increasing the money supply. We could be doing other functions to increase liquidity, right? And to keep that money moving around. So what we'll start to see is looser and easier and lighter monetary policies. We may see changes in things like, bank capital control rules, or there's like a whole bunch of other things that can be done to increase the amount of money that moves around in the economy. I mean, there's already no minimum reserve for the fractional reserve banking in Australia, so they've already like pulled that lever, right? But there's kind of plenty of other ways to tackle that. So what this kind of means, though, as your broader point was like, but what does this mean for the everyday person as we think about going into 2025, right? So what this means, if you have a loan, that does mean that you're going to end up with more money in your back pocket. That means that your repayments are going to go down, subject to you having a variable rate mortgage rather than a fixed rate, right? What that would mean is your borrowing power would go up. So potentially you've got the ability to refinance, even if you're on a fixed rate mortgage. You could potentially refinance to a variable rate or an interest only or something like that. So yes, this can translate to more cash in your pocket. That can translate to less household monetary stress. That can translate to more spending power for the everyday Australian. That can translate to actual money being spent in the economy, which, if you remember, GDP is trending down in a very bad way. We're currently 0.8%. So if some of the money that is getting allocated to interest payments instead got allocated to things like entertainment, holidays, spending, what we'd actually see is we'd see a stimulation of the Australian economy. That would be good for the economy. And so it's really just about where does the kind of capital move in these markets and how. But what this should translate to is a transfer of the liquidity from debt holders, i.e. the people that own the debt, to the everyday Australians. So rather than just getting shifted that way. So it should translate into like better for everyday people, more money in your back pocket, that kind of thing.
Yeah, it's funny. What I was just thinking then, it's kind of like if a shop owner, I always think of like a milk bar, but if a milk bar owner went outside and gave all the potential customers an extra $10, those customers are likely to come in and spend that $10 in the milk bar. And so it's kind of that's part of what they're aiming for, right? They're trying to stimulate consumer spending as well by giving more into the pocket of everyday people so that they have more to spend.
Yeah, it's a tricky one though, right? Because it is also true that so I heard recently that there's Elon Musk's Doge, that with all the money they're saving, he's talking about, well, why don't we just give back to the people? Why don't we send everyone a $5,000 check? We can save $2 trillion. We'll send everyone a $5,000 check. Now, if you did that, that would almost certainly be inflationary, because what you would have is a sudden influx of capital seeking ostensibly the same amount of goods, right? And that would be not good. It'd be inflationary, and that would be counterproductive to the objectives of the. And so it's a very tricky kind of thing to manage the economy. So you move one needle, and it's always a seesaw. But broadly, what we should see is, for example, if interest rates go down, and we know that private sector debt is more than government debt, so we can assume that households and businesses own more debt than the government. So what would happen to businesses if their debt repayments went down? Well, they'd probably be able to employ more people. That'd be good, and so that would increase household incomes, or potentially they might be able to increase wages, because wages have been broadly not performing very well versus debasement. So that could be good for the everyday people. You would also see household expenses go down because the cost of the mortgages goes down. cost of rents probably wouldn't go down because of the amount of rental demand versus the amount of rental supply. So that probably wouldn't be affected there. But you would start to see some of that money trickle through the economy in a much more manageable way, which would then stimulate some pockets of the economy, more spending, more GDP growth, more productivity. So it can definitely be a good thing for the economy, as long as we don't sort of go into rapid liquidity expansion, i.e., rapid money printing and stuff like that. That's where it's the speed of absorption can actually kind of be kind of one of the main things that changes whether this is good or bad. If you took that $5,000 check that Elon Musk is talking about, and you said we're going to give you $1 a day for 5,000 days, well, that probably wouldn't be inflationary. It's still $5,000 that he's going to give to everyone, but it's $1 a day, so it's probably not going to be inflationary. Give it to $5,000 everyone on the same day, bang, almost certainly inflationary, and that's what happened during COVID. So, this is how this can affect GDP, and that's why the RBA wants to cut, because the GDP is lagging. As I say, we're in a per capita recession. We've had negative GDP growth per capita for the last 6 quarters. That's not good. That is not good. And so what needs to happen is we need to stimulate more productivity. We need to stimulate more growth. We need to stimulate more output in the Australian economy. And one of the best ways to do that is to lower the cost of capital, increase people's ability to spend within the economy, but we want to do that in a way that's non-inflationary.
What do you think the impacts on the Australian dollar will be if we continue through, if we're entering an easing cycle?
Yeah.
What do you think the impact on the dollar will be, and how does that?
Well, it's a good question.
How does that impact people?
Well, so it's like dollar versus what? Like dollar versus the US dollar? Because that's kind of probably going to be the right proxy. Because it's sort of going to be like, what is anything worth? It's only ever worth something if you compare it to something else.
Comparison.
Yeah.
Yeah.
So I think that's an interesting question because,
Because I imagine that, very high level, when you have a high interest rate, we are more appealing for foreign investment to invest in, because they can have their funds here and get a higher rate than potentially have it in the US or somewhere else.
Yes.
And so as we lower interest rates, they're going to start pulling their funds out to be in higher interest rate markets, right?
Yeah, but it depends on the other markets. Because if the US dollar also weakens significantly, if interest rates drop significantly in the US, now the challenge, the thing about the US dollar is that is on a secular uptrend of strength, and the reason it's a secular uptrend of strength is because people need to buy dollars. There's a constant bid for the US dollar because it is the global reserve currency, and so that's why the US has more capital flows, because it's the dominant currency that people use. So money tends to. And the trend is that more and more money flows to the US capital markets than other markets. So there's a constant trend of the US sucking in the world's capital, right? That just continues to happen. That's why more and more money goes into the US stock market, all of that kind of stuff. And so things have to be pretty, so like the Australian dollar has to be very strong compared to the US dollar in order for people to choose the Australian dollar over the US dollar to move capital that way. But if interest rates are higher and stuff, then there's a reason to do it. But all things being equal, if both currencies are lower in value, then people will still choose the US. So it wouldn't necessarily. We can see the Australian dollar maintain itself against a falling US dollar. So we could effectively see the US dollar the Australian dollar go down. But if the US dollar is going down as well, then we're going to see those two things trending down in the same direction. And that would then that would be like versus other parts of the world. So it's always going to be in a comparison. It's interesting. Kind of currency fluctuations are a pretty interesting thing. I noticed today that the Australian dollar had strengthened against the euro because, and this is why I actually mentioned about the jobs print that I think I've missed today. And that was actually because there was like a strong jobs print in Australia, which I didn't get to the bottom of before we jumped on here. So different things are going to affect different consumer sentiment or different market sentiments around what currencies are going to be best to be in. But broadly speaking, if we can make the Australian dollar cheaper and lower the cost of capital in Australia, it's going to make us more competitive in a global market, increase exports, all of that kind of stuff. So,
and generally speaking, how does a lower dollar impact people on a daily basis, Australians?
Yeah, so it depends on whether you're an importer or an exporter. So if you're an exporter, then it is good because more people want to buy your stuff. And in relative terms, you can either charge the same amount in Australian dollars and it's going to be cheaper for the people that are buying the stuff overseas, or you can charge more and it's going to be the same price for the people overseas, but you get to keep more profits. Right? So you get to do one of those two things if you're an exporter. If you're an importer, then if the Australian dollar goes down, then everything else gets more expensive, right? So if you've got to import stuff from the UK and the Australian dollar falls against the pound, then guess what? Your stuff just got more expensive. so it really depends on whether you're an importer or an exporter. Now, Australia is a producer nation, right? So we actually export a lot of stuff. The US is a net importer. So what they're actually trying to do is change the construction of their economy to your onshore more manufacturing and more production so that they can become net exporters, so they can kind of benefit from the weakening US dollar as well. So that's, and then obviously more money flowing into Australia, that's good, better prosperity for Australian people.
Yeah, it's interesting though, because I think through like consumers, I just think through everyday people, if their rates are coming down and we're in this stimulatory environment where we're being motivated to spend more and consume more in both domestically, but I think there will also be increased appeal to buy more foreign things as well on a daily basis of like consumables and buying things on Amazon and all that kind of stuff as well. So I see that potentially coming as well.
Yeah. Yes. Josh has just said there's a lot to take in here. We'll need to rewatch to understand more deeply. So I apologize. Yes, there is a lot to take in here. So I do apologize if I've dumped so much on the table. If you have any questions and you're here live, you can ask questions and we can answer them live too. It's a great opportunity to do that. One thing I would just say to kind of bookend this, and maybe we can start to kind of shift, answer a couple of questions that we've got in here as well. Because we've kind of covered most of the key points. You're right, Josh. Nobody else is talking about this stuff. The kind of big takeaway for me here is not, oh my God, interest rates have gone down 25 basis points. Sorry, actually, let me take a little step back. There's one more point that I didn't cover. That is that the ASX RBA futures derivatives market is pricing in another. Big mouth.
It's a lot of words, man. It's a lot of words.
Yeah. It used to be more words, but it's they narrowed
That's
it down.
the shorter version.
That's the shorter version. Yeah. It was the ASX RBA 30-day interbank futures derivatives something, right? So
sweet.
Anyway,
nice. Catchy.
Basically the futures markets on the cash rate is kind of pricing in roughly a 50 basis point cut by the end of the year. So that's another 0.5%. So does that come in 2 25 basis point cuts or 1.5%? I think it's more likely to be 2 25 basis point cuts, or it's actually pricing in 60 basis points actually, as I rounded it to 50. It's actually pricing in 60 basis points cut. So that could take the form of 1.5% cuts as well. So what I think we could reasonably expect is the interest rates are going to continue to trend down a little bit over this year. Not massively. We're not going to go to zero. But, we can reasonably expect that it's going to continue to trend down. But the big story here is not so much that. The big story here is, how do we think about what this means for the economy and liquidity and investing over the next 12, 18, and 24 months? Yep. Now, there are so many pieces to this puzzle, right? There are so many, and this is what I've become more and more interested in economics and macroeconomics because of the complexity of the architecture of it. Do one thing here, change the price of corn in Kazakhstan, and all of a sudden, silk prices in Argentina go through the roof or something, right? It's crazy. It's wacky. So you've got to try and pull all this together and go, okay, what does all this kind of directionally mean? And how can we start to think about this? One of the things that I think is broadly going to be very true over the next 12, 18, and 24 months is that we will see an easing of monetary policy, which is going to increase liquidity. So they probably won't call it QE. There'll probably be something else. The Canadians recently did QE, but they changed the name because everyone knows that QE just means money printing now, right?
Everyone knows what that means now. Yeah.
Everyone knows what it means.
In 2020, no one knew what that means.
Yeah. So I'd be willing to place a bet they don't call it quantitative easing, right? But I can't remember the terminology that the Canadians used, but it wasn't quantitative easing, but it was quantitative easing, right? It was money printing with a different name. And there's kind of two ways that they can do that. They can directly kind of add capital into the system. That's effectively quantitative easing. They could call it something else. Or they can do something called yield curve control, where they can artificially control the rates on treasury bonds by they can kind of manipulate the rates on interest on treasury bonds. That's yield curve control. That's another form of money printing. That's another way to kind of stimulate bond issuance in a way that can kind of create more capital in the markets. So I think that what we'll reasonably see over the next 12, 18, and 24 months is we'll start seeing easing of monetary policy. I don't think it's going to be rapid. I don't think we're going to see something like COVID, where it was just like money print to go burr, like brrr, let's go. I think it's going to be a sort of an 18-month to 24-month progression, and I think that's good. By the way, I think that's really good. I think that's actually probably the best scenario, because what we'll see is we'll start to see interest rates trending down, probably slowly, and again, I think that's good. We'll start to see monetary policy easing, and that's going to bring more liquidity into the market. And what that will do is that will prop up hard assets. Now, hard assets are going to be things that they're either going to be bearer instruments or going to be physical assets, things that are scarce, desirable, all of that kind of stuff. So things like real estate are going to benefit greatly in this kind of environment. Things like Bitcoin will benefit greatly in this kind of environment, but that's more of a global liquidity thing versus an Australian liquidity thing. But from an Australian market perspective, I think we can reasonably expect that we're going to see a lot more upward pressure on real estate prices in Australia, because we're going to increase the accessibility to the market by lowering interest rates and allowing more people to get access to credit. That'll allow people who can't get in to get in, and that'll allow people who are already in to spend more. So what we'll see is an upward adjustment in kind of prices and capital flows into the market to move that upwards, and that should broadly elevate prices of property in Australia. So that's going to be good if you're into making money through property. It's going to be good. And also it's going to change kind of the dynamics of job markets and stuff like that. You probably see a bit of a shift in the Australian share market as well. But frankly, I mean, I have no love for the Australian capital markets. I have no love for the Australian stock exchange. I think Australian capital markets are a backwater, and I probably wouldn't be advocating people to allocate capital there. If you're interested in stocks and stuff, you should look at the US market, because they have much better capital flows. But Australian residential real estate is awesome, and we can start to see that it's going to move in that direction. That's kind of the big thing to think about. I don't think there's going to be, a lot of people say, because of the 18.6 year cycle and whatever, there's going to be some big crash. I can't see that happening. I can't see, where is that going to come from? We got so much structural underpinning that's driving this forward. I actually think what we're going to see is a consistent move in the right direction. I think it starts now. I think it started probably a couple of months ago. And you can get on now, and you don't need to be scared you're going to miss out, but you should take action soon, because more and more people are going to get into the market. Every time there's an interest rate cut, or every time things get a little bit easier, more and more people are going to want to participate. So if you're thinking about doing it, now's the time to kind of get into it.
Awesome. Yeah, because there's two, I think, train of thought going into why prices are most likely to go up, right? Everything you just explained there would be one. And then there's the more simplistic approach of more people can borrow, more demand for properties, still property shortage, prices go up. That's how a lot of people are looking at this, which is true.
Yeah.
That's one piece, but then what you just explained is the other piece. That's more the complex of why it's going to continue to go up.
Yeah. And Josh has just asked a question here. Given what I just said about increased liquidity, how do you ascertain actual growth in my net worth holding real estate versus what's just inflation since purchasing power decreases? I think it's a really great question, Josh. That's an awesome question. What I would say is everything is perception, right? So in dollar denominated terms, your net worth will increase in dollar denominated terms. Now, if you were measuring your net worth in an asset that didn't inflate, then you would have an appropriate metric to work out whether or not your net worth had actually increased. Now, the only non-inflationary asset that I know of is Bitcoin. And what we can see is that everything is trending down versus Bitcoin, basically, over time. So I would actually look at that and say, I'm taking my fiat out of the system and putting it into a hard asset. And so to the degree that fiat, that it changes value in fiat terms, if I live in a fiat world, then it has actually changed the net worth. It has changed the net worth. Now, you could measure it by the increase in money supply, and you could say, "Oh, you've got a thumbs down, Gabby. Boo."
Oh,
uh,
thumbs up.
you could measure it by the increase in money supply, and you could say, okay, well, if the increase in money supply has gone up by, let's say, 10%, but my property has gone up by 20%, then why would those two things be different? Now, that's an interesting question to ask, and the reason for that is because demand doesn't flow equally through the market. So the way you sort of look at it is you say, okay, let's take all of the liquidity in Australia and let's divide it by all of the goods, assets, and services in Australia, and then you sort of create some kind of equilibrium. But that it doesn't mean that money flows equally to all assets at all times. It doesn't mean that just because your house goes up by 20%, that a packet of chewing gum should go up by 20%, or that somebody else's house is going to go up by 20%. So what we actually have is we have a matching market economy in real estate. So a matching market is different from just supply and demand, because if it's just purely supply and demand, then it's just like in aggregate increase houses and people will live there. But that's not true, because those houses or those properties or those apartments have to have certain characteristics that make you want to choose them. So it's actually not dissimilar from a dating app. So yes, if there's demand in an area and you need supply, and so you do have supply and demand characteristics in an area. But if you zoom out a little bit, why would someone choose to live in Bendigo versus Mount Gambier versus Toowoomba versus Bunbury? Right? They're going to be different characteristics around those locations. So in effect, that's what we call a matching market. That means that individuals are looking for characteristics to match with. So it's much more like a dating market than it is, say, a commodity market, which is like people want to eat wheat. We increase wheat production goes up, wheat prices go down. There's more supply than demand. It doesn't work in aggregate like that, because different people have different needs. And they look at, some people want a pool, some people want a red roof, some people want a big garden, some people want an apartment. So actually the real estate market acts much more like the dating market than it does a commodity market, which is a commodity market is almost entirely driven by supply and demand. But the real estate market is much, 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 much more driven by a matching market phenomenon. And so you can look at, okay, monetary supply in the country is increased by 10%. Okay, so there's 10% debasement. Cool. But my property went up by 20%. That's because there are more people who want to match with the location I'm in. There's more desirability, there's more demand, there's more whatever in that area. And demand shifts. It doesn't distribute equally. So that's why some markets go up and some markets go down and some markets stay flat. And so even some markets can stay flat and other markets can go up if we have an increase in the number of people coming into the country, because demand can still flow disproportionately to one area without sucking demand out of another. So that's how we start to get these discrepancies between why some suburbs go up, why some suburbs stay flat, why some suburbs go down, and why we don't have in aggregate an Australian property market. So I hope that answers your question, Josh. What do you think about that?
Nice. I started laughing because I was remembering this meme that you sent me a couple of weeks ago. But
have you got
Josh's
it there?
question, I do have it. I do have it. No, I've got it.
This is my favorite meme. I've been wanting to get this on the podcast.
It's I think this summarizes your point, Josh. It's like, how do I know? Like, here I am thinking I'm being a good investor, but the market is just kind of like doing it for me. This is also part of the argument for like, you need to invest. Like, don't just keep your money in cash right now in the environment that we're in. It's like inflation is going to do a lot of the work for you, but you're still going to benefit from it.
Yeah. The caveat to that, though, is everything I was just saying about the matching market aspect, right? So I love this meme, and that's why I sent it to you up, and there's a lot of other people loving this meme as well. It's a hilarious meme because the best memes are hilarious because they're true, right? So
yeah. Sorry, I should explain the meme because we have people that listen just audio. So it's a meme of like two cartoon characters. One guy is holding up a kid that's reaching and putting a ball, like a basketball, in a basketball hoop. The guy that's holding up the kid says, me thinking I'm good at real estate. And then the guy lifting him up says inflation. So it's the point being that most of us are acting like this little kid that's going, hey, I'm really great at this thing. Yeah. But actually inflation is doing a lot of the work.
Yeah, 100%. And so Josh has actually asked a follow-up question, which is related to this. It's related to what I was about to say about this. He said, it seems over the past 4 years, everyone's now a buyer's agent. And I've wondered how much of their success has just been inflation. And I think it's a really good question, because because of monetary debasement and because of the effect that that has on the Australian property market, it is very hard to stuff it up in Australia, right? It's actually quite hard to stuff it up over an appropriate time horizon, right? So over 6 months, yeah, maybe whatever. But you don't have to be a genius to make money in property in Australia. The question then would be, to what degree is there outperformance? Because if someone's kind of getting average performance, then what you'll find, then you can underperform the average, right? If you buy a property in a location that is on the opposite side of the kind of matching market demand and no one wants to be there, then you can lose money in property. If you buy a property and it goes up like basically in line with the national average, then it's probably moving in line with monetary debasement and you haven't really done much. The question would be can you get outperformance? And how do you find the outperformance? And the quest for, or this is what we call alpha. So the quest for alpha is the ability to identify underappreciated markets that are untapped, that are earlier in the cycle, where you can, we talked last week about mean reversion. So when you can find stuff that is got a mean revert to the upside, where it's maybe one or two standard deviations below the mean, and you can kind of capture the upside. So it's about understanding where can you find alpha. That is the difference. So yeah, I would say that a big reason that people are like, yeah, we bought someone a property and it went up by 50 grand or whatever. It's like, yeah, that's cool, but like, how much of that was strategic? How much of that was just because, like the meme, it's just being propped up by inflation? And this is where I think outperformance has to be kind of taken into consideration.
And we come across this question all the time, right? It's less so these days, but particularly in the last year, 2 years, and coming out of the COVID period, a lot of people coming in to ask about working with us and just say, like, not believing that we did anything differently, because everyone got good results in the last few years. So what, like, you're just riding the coattails of the market moving and inflation and everything. And so I'm just looking at Goose. I've got the portfolio growth system doc open,
perfect.
which actually might. We're the same person, my love.
Can you just bring up the chart, that graphic, slide 28, I think it is, in the portfolio growth system, the one that shows.
Yeah, I'm on there. That's so funny.
yeah, awesome.
Yeah, I'll pull it up. Share this tab instead, and I can put this in the show notes.
Yeah, let's put it in the show notes. So if you can see this, so we actually track, because this is such a great question, Josh. And by the way, this wasn't supposed to be spun into like a let's promote Dashdot kind of thing.
No, but it's super relevant. Yeah.
Seeing as how you asked. So we actually track the locations we select versus combined capitals, combined regionals, all of that kind of stuff, to then work out, have we been able to achieve alpha versus other opportunities and other markets? Basically, can we outperform the market? Because that's evidence that we're actually able to find that, right? So you can see here, if we just look at the big numbers on it, we'll share this document. You can have a look at this document yourself, by the way. That's fine. You can see here, and this is only up to September 24. We're about to do an update.
We're about to do an update.
We're about to do an update that includes the December quarter as well. But you can see here, we outperformed capitals by 160% on average in the last quarter. So that's 20.3% versus 7.8%. And we outperformed regionals by 207%, which is 20.3% versus 6.6%. Now you can see tracked every quarter back to December 2022. We just didn't track it before then. So that's why we don't have it. But we've had this kind of outperformance all the time. You can see that in every single quarter, we have outperformed both regionals and capitals every single quarter. And so this is the difference between buying properties and letting inflation do the work, and versus having the technology, tools, team, and expertise to be able to identify the right property in the right place at the right time to seek alpha in your portfolio. And really, the game is not how do you tread water at market rates. The game is how do you get ahead, not just kind of ride the wagon of inflation and kind of keep your money the same. Because if you wanted to do that, you might as well just buy the S&P 500 and go to bed. But this is how we've been able to do that. And then if you amplify that difference with the inclusion of leverage, what you actually end up with is rather than, can you scroll to the right so I can see the kind of big, so rather than say 160% outperformance versus capitals, once you add leverage into that, you're probably adding another 3 to 4 X on top of that,
Yeah.
right? Because if we've
Yeah.
outperformed by 160%, but you've got the leverage component on top of that, then you've got the amplification of that return on invested capital as well. So it becomes very significant, it becomes life-changing. And this is the difference between a portfolio taking you 40 years to kind of get to your goals, or a portfolio that takes 15 to 20 years, or 10, or even 10 to 20 years to get to your goals. So that's the kind of difference. So yeah, it's a really good question. Anyway.
Yeah. So I was just looking at so in September, the capital's average annual growth rate was 7.8%. So that's the comparison there.
Yeah. So yeah, we did 20.3. The suburbs we selected did 20.3%.
Yeah.
Versus 7.8% in the capital. So that's the 160% outperformance.
Awesome.
Cool. Awesome. Great questions.
Great
and great
side quest.
Thanks,
Josh.
Great side quest. That was good. Okay, so I'm mindful of time. If you've got any other questions you want to chuck in there as well, shampoo time, you've asked. So what does this mean for people with 1.5 million
shampoo
investment
time?
debt? I don't know. I'm not prepared to do public maths on this.
Do it.
No, I won't do it. I'd have to pull up. I would have to pull up a mortgage calculator and stuff. I'm not going to do it.
Use your brain.
No, I don't know. It does depend on
I'll sing while you do that.
What are the current interest rates? But what we established at the start is that there's basically it'll change your borrowing capacity by about 2 to 5%. So then you would imply that you would get about a 2 to 5% saving, right?
Yeah.
Something like that. So it's going to save you a little bit of money. I won't do public maths. Apologies.
I did have, I did have a number somewhere in my notes. Give me 1 second. Let me remember. Because it was per million in debt.
Oh yeah.
It always gets a bit loosey goosey by the time we get to Q&A. But here we are.
It was like 15,000 for every 500,000, isn't it?
So it says a 1% rate reduction on $1 million of debt can lead to up to $20,000 additional cash flow per year, obviously depending on what your rate is.
So
but
if it's 25 basis points, that's a quarter of that, right? So we're saying $5,000 for every $1 million.
Yep. And then so 1.5 million would be $7,500.
$7,500. Not
public math done.
Go speak to your broker. Double check that. Don't take that as fact. All right, awesome. Cool. I think we've kind of covered off everything we need to cover off today, Gabby.
I think we have. If we have any last questions, we will wrap up in a second. I want to know what everyone is thinking in terms of how they want to approach this year. Like if rates are going to keep dropping, they might, like we've been talking about, they're probably not going to steeply just consistently drop every single month. But how are you now thinking about investing this year or not investing this year? Or how do rate changes for you guys here live? How do you think that you're going to approach this year if we continue to see drops, and next year? I would love to know that.
Whilst people are writing their stuff in there, potentially writing their stuff in there, let me just quickly show you this graphic that I found, which I think is a really good highlight of kind of what I was talking about the extraction and contraction and expansion of the kind of monetary cycles. It's actually on the RBA website here. So this talks about the business cycle, but the business cycle is broadly the liquidity cycle. So we've been going through a contractionary period of the monetary cycle right now, and then we're about to move into an expansionary period. So output, that's a function of GDP. So what we should reasonably see is output, opportunity, growth, all that kind of stuff start to peak up, and we kind of go in these waves. And so we are probably right around here right now, which if you just think about that, and if you think that this is probably something like a 2-year transition, 2-3 year transition, that means that it appears that we're moving into a cyclical kind of uptrend, which is pretty cool.
Yeah, that's cool.
Sweet. Okie dokie.
Cool. Yeah, Josh, you've said need to find additional levers to grow cash flow to leverage more debt. It is becoming a function of managing your constraints, right, Goose? Like,
yeah,
it's going to be things are going to grow, so you're going to have more value. If you're an asset holder, you're going to have more things that you can leverage, but you still need the serviceability to be able to do that,
100%.
which means you need the cash flow to be able to maintain the serviceability.
Yeah, and look, and everyone's gonna find edges, and there's ways to kind of navigate around that. There's structures that you can use for your portfolio, so you can isolate debts. But yeah, effectively, every property portfolio is going to be constrained by one of three functions: access to capital, access to debt, access to cash flow. And so, to the degree that you can manage those, and you can increase your income, that means you can increase your debt, which means you can increase your access to more properties. You're going to benefit more and more and more and more from this, inflationary cycle. And by the way, we should do a whole episode on how the deflationary forces of technology are going to drive inflation, because this is monetary inflation is not something that's going to go away. In fact, it's something that's most likely going to accelerate. And so the degree to which you can position yourself in scarce desirable assets now is going to be the degree to which you could benefit from what will be a cyclical trend of increasing money supply, because they will have to inflate against the deflationary forces of technology. So, so you're on the right track, Josh, and everybody else who's thinking about getting into scarce desirable assets, hard assets like real estate. It's a great opportunity. It's a fantastic opportunity to grow your wealth moving forward. Awesome. All
awesome.
Right, let's wrap it up. Thanks for joining us live today. If you haven't joined us live, remember, we do this live every single week. We love seeing you here. For those of you who came, great to see you. Nice to see some familiar faces or some familiar names in the room. Good chat today, Gabby. Had a lot of fun. And if you like this, make sure you hit the like button. Make sure you hit the share button, send it to somebody else you like, and make sure you subscribe as well.
Yeah, shares are super valuable. I think obviously if you're here watching this, it's you are growth minded and you want to try and make the most of your life, and that a lot of that is that financial understanding. And we really wanted to do this topic because I think a lot of people are speaking about this topic in terms of the rate cuts, but they're not maybe speaking about it in a way that's actually going to serve you. So if you have gotten value from this episode and you think somebody else in your life will benefit from it as well, do share it around. That is the way that we can reach more people, basically. So
100%.
Awesome. Thank you.
Thanks, guys. See
you next week. Bye.